So our focus in this presentation is going to be about callable corporate bonds and make-whole call provisions in particular, but the first thing you need to understand is why this is so important. First, we've shown how a select portfolio of individual corporate bonds can outperform the leading bond funds and ETFs. And think of it as when you create a select portfolio of bonds, whether it's 20 bonds or 30 bonds or 40 or however many it is, you're creating an all-star team of the bonds that have the best opportunities to perform over the long term, compared to what I would say is a recreational league team, which is what basically bond funds are, where you own thousands of different bonds, a lot of which aren't really any good, and you never really know what's in your portfolio. You can't tell if you're getting a good value or not because bond funds are priced on a per share basis. There's no underlying financials. There's no fixed coupon. So there are significant advantages for owning individual bonds over bond funds. But then the question is, okay, if you're going to own an individual bond, then how do you decide among, say, a corporate bond or a municipal bond or an agency bond? And where you start to make that decision is, well, how do these different bonds work? And a key part of how they work is the call provisions of these bonds. And in particular, the make-whole call provisions that corporate bonds have compared to the early par call provisions that municipal bonds and agency bonds have. Remember, if you benefit from this video, be sure to click the like button, and be sure to subscribe as well if you haven't already done so. So many people, when they hear callable bonds, I'll hear people ask, hey, is this bond callable? And that's not really the full question, because other than US Treasuries, most bonds are callable. And the question is, well, how are they callable? Meaning, when are they callable? When are they first callable? And at what price? And that's where you start to come up with differences in terms of how bonds work, because people will say, well, if I'm a high tax bracket, and that's why I invest in muni bonds, because my tax equivalent yield is so much higher than a yield on an individual corporate bond. But we're going to show you why that analysis is the tax equivalent yield analysis is generally irrelevant, because the call provisions of corporate bonds are very favorable to bond investors, in particular investment grade corporate bonds, compared to the onerous call provisions that are contained in municipal bonds and agency bonds. So you can't just look at it as, well, is the bond callable? Because other than US Treasuries, virtually all bonds are callable. So how do different bond call provisions work? And we're going to show an example of 3 different bonds. So one is an investment grade corporate bond. So Amazon, 4.875% due March 13th of 2036. The Long Beach Township, New Jersey bond, 3 1/8 due March 1st of 2036. And then an agency bond, Federal Home Loan Bank, 5% due February 13th of 2036. And so I wanted to select bonds that have similar maturity dates, just so we can get an idea in terms of how the different call provisions stack up for these different bonds. Let's first take the Amazon bond. So this bond it's due in 10 years, and it has a make-whole call until 3 months before maturity. And we're going to get into the detail in terms of what a make-whole call is. But a make-whole call is in the bondholder's favor, because if the company wanted to redeem this bond, say in year 2, it would have to pay the bondholder the present value of the future interest payments and principal payment. That can be a significant amount, as we'll show you in a little bit. This bond also has a par call, meaning that the bond is callable at par value, but that's not until 3 months before the bond matures. The muni bond and the agency bond are completely different. They have par calls. This Long Beach Township, New Jersey bond, it has a par call that's already in place. So I'm shooting this on June 2nd of 2026. This par call took effect on March 1st of 26. So think about it. If the bond is callable at par, there's virtually no chance for the bond to appreciate materially above par, because no one's going to want to pay, no one's going to buy this thing for 107, knowing that the bond can be called basically the next day at par, or even 104. It can barely move up. So it does a couple of things when it has this par call. So first, the idea that when you buy this bond that you're locking in a coupon payment for the next 10 years is false, because that bond can get called at any point, compared to the make-whole call, where they could call it. I'm going to show you why they don't call it well before maturity. They could, but if they do, they have to pay you the present value of the future payments that you would have received. The agency bond is very similar to the muni bond in terms of its call schedule. Again, call provision, it has a par call on June 8th of 26. So again, your future interest payments are at risk, and there's virtually no chance for this bond to even appreciate a few points above the par value, because it can be called at par, right? Beginning June 8th of 2026. So when I give these examples, it's important to know kind of where they came from, right? So I did a search on fidelity.com. This is a search that I did back in August 21st of 2025. Now, the fact that it was done in August of 25 doesn't really matter, because it's not as though you had bonds, like tons of bonds. Like the bond universe hasn't really changed that much. It might have changed at the margin, but these examples are still relevant. And what we show here is we're comparing groups of bonds, and we're showing bonds that had maturities between August 2034 to 36. They're called that 10-year maturities. And then August 2044 to August of 2046, so close to 20-year maturities. And we looked at samples of both municipal and corporate bonds. For the municipal bonds, the sample size was 18,419 bonds. And for the corporate bond sample, it was 711 bonds. And out of these 18,419 bonds, the median number of years that these bonds were callable at par before maturity was 4 years. Now, of course, there are some bonds that were callable 10 years before maturity, but the median was 4 years. For the corporate bond, for the corporate bond sample, that median was 1/4 of a year, or 3 months. So again, you know that you're going to get your interest until that bond is potentially called at par 3 months before maturity, compared to this muni bond sample, where it could get called, again, in this specific sample, 4 years before maturity. But again, you've got lots that are callable 10 years before maturity. Now, when we look at the 20-year bonds, this is where the difference becomes even more significant, because you're buying a 20-year bond, you're thinking, oh, okay, well, this bond is going to be paying me interest for a significant period of time. But again, when we look at the sample for municipal bonds and corporate bonds, so we had a sample of over 1,500 bonds for municipals, 382 bonds for corporates. And when you look at the median bond within these different samples, that within the muni sample, the median had a par call 11 years before maturity. With corporate bonds, it was half a year or 6 months in terms of the median bond within that huge sample. So again, it's a significant difference when you look at munis versus corporates. And so when people harp on the tax equivalent yield, folks, that's an irrelevant metric, because when people use the tax equivalent yield, they're assuming that you're buying the same type of bond, but you're not. If the corporate bond has a much more favorable call provision, where you know that you're going to get this interest until the bond matures, compared to the muni, where that interest could evaporate, it's not apples to apples. In addition, if a municipal bond is callable well before maturity at par, it limits the capital appreciation. So you can't say, well, this muni bond's tax equivalent yield is a little bit higher than this corporate bond. Well, if the corporate bond can increase in price 5, 6, 7, 8, 9 points, and the muni can't, that has a material impact on the potential return of the bond. So I would sort of throw, the whole thing about municipal bond tax equivalent yield is it's not a meaningful metric. It's completely overused. So when we talk about make-whole calls, and so again, make-whole calls are generally limited to corporate bonds. The call provision that gets assigned to bonds is done at the issuance, when the bond's issued. So if a bond has an investment grade rating, generally speaking, that bond is going to have a make-whole call for basically the entire term of the bond up until the bond is callable at par, whether it be a few months or 6 months before. High yield bonds can be a little bit different. There are many high yield bonds that have a make-whole call provision for nearly the entire term of the bond. Others, generally bonds that are lower rated, could have a make-whole call for the first several years after issuance, and then the bond will be subject to a call schedule, which is in a separate video, and it actually relates to yield to worse and some other things that we'll show that we have in other videos, which you can watch here. When we calculate the make-whole call, so again, if a bond issuing company wants to invoke a make-whole call, it has to pay the bondholder the present value of the future interest payments and principal payment. And what we've done here is we've taken the Amazon 4.875% bond that's due in 2036. And we're assuming that we're going to potentially redeem this bond September 13th of 26. This is all illustrative, okay? This bond has a coupon of 4.875%. When we look at the scheduled payments, it pays interest semi-annually. So 1/2 of 4.875 is, or $48.75 per bond is $24.38 per bond. And that interest gets paid every 6 months. So the bond was originally issued March 10th of 26. The first interest payment would have been, again, this is we're saying we're going to redeem this bond, but the first interest payment would have been on September 13th of 26. So when we look at the scheduled payments, there would be all these interest payments, $24.38 every 6 months for each bond. Then there's the principal payment, and when we calculate the make-whole call payment, it's assumed that principal, it gets discounted starting on the par call date. In this case, the par call date is 3 months before, as I showed a couple slides ago, or December 13th of 2035. But again, these are the scheduled payments. The way the terms of the bond work in terms of the make-whole call is that it's to pay you the present value of the future interest and principal payments. Now the question is, okay, so when we say present value, so what's the discount rate? And the discount rate is based on the U.S. Treasury yield, the benchmark U.S. Treasury yield, which I'll explain in a moment, plus some margin. And so in this case, this is about a 10-year bond. So it's June 2nd. The 10-year is trading right around 4.5%. The term, in terms of how this bond works, in terms of the discount rate that's used, is that it's the Treasury, which is based on the time to maturity. So there's about 10 years to maturity. In this case, 9.25 years, but we're just going to say 10 years. So you look at what the benchmark Treasury is, or the Treasury that's due right around the same time that this bond is due, you take that yield and you add 0.15 percentage points, also known as 15 basis points. So this discount rate, which we show here at 4.65, all that is you're taking 4.5% U.S. Treasury yield plus the 15 basis points that gets you to 4.65%. And all we're doing is we're taking these payments and then we're discounting them back to the redemption date. So in this case, this payment of $24.38 would have been made half a year after the September 13th redemption date, and that's why it shows the discounted value here of $23.83 compared to the actual dollar payment of $24.38. You then look at all the future interest payments and principal payments, and then we got to discount those back based on the number of years that the payment was supposed to have been made. So the par call date is 9.25 years out. So in that case, we're going to discount the interest payment, $24.38, the principal payment, so a total of $1,024.38. We're discounting that 9.25 years at 4.65%. And that, in that case, the present value of those payments is $672.78. If you add all these payments up, you get to a present value of all these future payments of $1,028.79 per bond. Face value of a bond is $1,000. So when we look at this in terms of a percentage of par value or face value, it's 102.88. So not that much above par value. But the thing is that Amazon would never redeem these bonds now because the bonds were issued March 10th of 2026. Treasury yields have gone up since then. So they'd be issuing bonds at a higher coupon than they issued them in March or early March of this year. So there's no reason for them to try to redeem these bonds early. Now, let's say that interest rates fell and people will be like, well, you know, if interest rates fall, then they're going to be compelled to redeem these bonds. But let's look at what the make-whole call payment would be. So again, it's the same calculation, only that we're using a different discount rate. So here, the 3.65, we're assuming that the U.S. Treasury yield would fall from 4.5% down to, say, 3.5%. You add the 15 basis points of margin above that per the term of the bond. And when you discount all these, you get a present value of $1,106.92 per bond, or 110.69% of the bond's face value. If we were to decrease the discount rate further by another percentage point, then the make-whole call payment goes all the way up to 119.26. So you can see how significant that increase is. Now, what people will ask, and this is why I think people can get hung up on callable bonds, is because they think, oh my gosh, my bond's going to be called, and that is a risk when it's municipal bonds, brokered CDs, agency bonds, because of those par call provisions. It's a whole different animal when we're talking about corporate bonds that have a make-whole call provision. So you remember from the previous slide that, as you would expect, as the discount rate gets lower, the present value of the future payments increases because you're discounting it at a lower rate. And you see how significant it was. And these are all the same numbers that I showed in the previous slide. The question is from Amazon's standpoint, how is it going to make a decision in terms of whether it wants to redeem the bonds or not? And so so this bond in particular, so this Amazon of 36 bond was issued, it was $6 billion. And what we've shown here is we've shown a few different scenarios. So we show, if we assume that $1 billion gets redeemed, $3 billion gets redeemed or $6 billion gets redeemed, and across different discount rates, what that make-whole call payment would be. And so if it's $1 billion, if they say, all right, we got to redeem $1 billion. So if they want to do that, and let's say that it's at 4.65%, that's not a significant payment for Amazon. It's $29 million for $1 billion. But again, there's no rationale to do it because they would be paying a higher coupon rate than they did when they issued the bonds originally. If the discount rate fell, and you say, all right, well, interest rates are lower, so then it would make all sense in the world for them to redeem the bonds. The problem is that they would then owe, just to redeem $1 billion, that would cost $193 million. And the way that you get that is, so you'll see here, the make-whole call payment is $119.26. That $119.26 is a 19.3% premium to the par value. So if you take 19.3% times $1 billion, you get $193 million. If they did $6 billion, then that would cost $1.156 billion. And so one of the interesting analyses is if you assume, so for $6 billion of bonds outstanding, for each percentage point that you save, that's $60 million a year, right? So $60 million a year, let's say over 10 years, so it's $600 million. If you're Amazon, you're not going to pay that. Now, it'd be more appropriate to look in this column because this is where interest rates fell by 1 percentage point. So the thing is that it'd be really hard for Amazon to say, okay, let's say interest rates fell by 1 percentage point. I could save for each percentage point, I could save $60 million. Amazon could save $60 million in interest expense, but to do that, they'd have to pay $642 million. So the $642 million, that's out the door day one. Whereas the interest that they save, that's over time. And so you have the whole issue of the present value of those future interest payments. So that's why these make-whole call provisions are seldom invoked, because it can be, because think of, you've got things working in different directions. So if you've got interest rates going up, your make-whole call payment is low, but then there's really no rationale to redeem the bonds because you're paying a higher interest rate. If interest rates fall, then yes, you may save a little bit on the coupon of the bond, but then you're also going to have to pay this fairly significant make-whole call premium. So if you want to learn more about bonds and you want to gain access to our exclusive bond recommendations, I encourage you to go to the Bondsavvy site. We've got all sorts of blog posts there, and you can gain access and subscribe to our bond recommendations. And last but not least, this is our disclaimer. So I founded Bondsavvy in 2017 to make bond investing simpler and more profitable for individual investors. This is educational because I'm a big believer that owning individual corporate bonds provides better outcomes than owning bond funds in terms of transparency, in terms of total returns. This is not individualized advice. I do not know your personal situation. This is based on my analysis of the corporate bond market, and in this case, my analysis of bond call provisions. And of course, if you enjoyed this video, I kindly ask that you click the like button and subscribe to the Bondsavvy YouTube channel.